Welcome, everyone. My name is Megan Cox. I'm the Marketing Events Manager at Curinos. Thank you for joining us for today's webinar. The future is here for commercial and small business transformation, what leaders need to know in 2026. If you have questions during the presentation, please type them into the question box in your GoToWebinar control panel. This webinar is being recorded, and we will send the recording and PowerPoint to you post-webinar. Now I'd like to pass it to Margarita.
Thank you. My name is Margarita Vacanti. I'm the head of our commercial and small business practice. Our session today focuses on driving profitable growth in 2026. We'll share key trends about what we're seeing and talk through best practices across the industry. You'll leave with new ideas and practical approaches for driving superior results. At the end, we'll also be announcing our dates for the 2026 Business and Wealth Summit and a live poll of where our guests would like to go. So make sure you stay until the end. As a reminder of who we are, Curinos provides decision intelligence solutions for financial institutions. We empower financial institutions to turn insight into bottom line impact, driving confident decisions, deeper customer relationships, and profitable growth. I've already introduced myself. Joining me also are Peter Serene, Managing Director in our advisory practice, and Bob Warnock, Managing Director of Client Management. We're going to keep this session lively and interactive, so please do feel free to jump in with questions in the questions box. All right, let's jump in. I'll turn it over to Peter.
Thanks, Margarita, and thank you all for joining us. To sort of set the stage here, one thing that we're going to do that's a little bit different than the way we've talked about these topics before is we've used the term business here at the top, and that's very intentional, meant to span small businesses up through corporates. And one of the reasons that we've made that choice to talk about these together today is that there are actually different flavors of similar issues and challenges facing both segments. And the other reason is that in our work across the industry, one of the biggest questions that keeps coming up is how do we serve our clients on a continuum from small business into business banking, emerging middle market, emerging commercial, whatever we might call it, up as those businesses continue to grow. And so we've responded to that by really thinking about some of the overlaps between the issues that those segments are facing. Looking at the market broadly, there are sort of three key points that define the space. The first is that these are the segments where everybody wants to be right now for somewhat different reasons, but competitors are piling in. Those are traditional bank competitors, whether that's regional banks looking to commercial businesses to drive deposit growth as they struggle to kind of break out in the consumer space. That is the widespread focus from banks of all sizes on the small business or business banking segment. And then it's everybody outside of the traditional banking industry, whether those be fintechs, newly chartered institutions or institutions in the process of applying for charters, or private credit managers. Now, that last one, there's some complexity in the immediate market environment, but you can't deny the impact that they've had in the space over the last half decade or so. And then there's sort of the elephant in the room on tokenization and stablecoin players. So everybody is kind of swarming the field to become the primary partner, financial partner for business customers. And one of the things that has resulted in is a real capabilities arms race, or if we want to put a little bit more of a positive spin on it, a renaissance in products. And that's true for small businesses who are finding sort of new ways to see their whole relationship on a single pane of glass, up through the largest corporates that are getting more deeply integrated through APIs and ERP connectors to their banks. The net result of this is it's harder to grow profitably. And there are two pieces to that sentence. It's only 4 words, but there are 2 big ideas in it: grow and profitably, and they don't always go together. So where that leads us is a real focus across these segments of capturing relationships, deepening within them, and then figuring out how to get those relationships priced so they're not only really compelling to customers, but they're also profitable to the bank. So with that set up, let's dig a little deeper. If we look at the next page, there are dozens of names we could have chosen to put on this page. And in some sense, the ones we've chosen are less important than the broad idea that focus on the business segment is really driving innovation and breaking down sort of long-held conceptions of what the art of the possible looks like in lending, in cash management, in payments. On the left-hand side in small business, if you look at sort of the direction of travel, one of the really big themes that we're seeing is an integrated financial services solution, not a deposit or payment solution, not a lending solution, but putting all of the customer's financial needs in a single package of products. You've seen that from non-bank competitors. You're increasingly seeing that from traditional banks that are finding ways to break infrastructure silos between things like merchant and lending and deposits and payments. And then we're all sort of watching with interest to see how, for example, the combination of Brex and Capital One results in tighter value prop integrations between card and the rest of small business. On the commercial side, we've been polarizing here and focused on the tokenized ecosystem, sort of stablecoin side of innovation. There are some who believe that is going to fundamentally change the nature of finance over the next 5 years. There are others who believe it's a flash in the pan. What's undeniable is that it is the debate. And you've seen really interesting partnerships and product launches that are dealing with some of the really big obstacles around interoperability and ease of onboarding for these solutions. Obviously, the largest banks are from a sort of in-house solution and tokenized deposit standpoint leading the charge. Equally, we could have made a whole nother page on all of the various ways that banks are integrating with ERP systems and APIs into industry-specific software. That's also sort of equally part of the story here. But the main takeaway from this is, if your product set felt pretty good 5 years ago, there's a decent chance that it's not going to feel pretty good 5 months from now. So this is really a time to focus on how we're thinking creatively about meeting the needs of the segment. If we go to the next page, we've talked a little bit about the what. I want to focus a little bit on the why, and we're going to play the hits and talk about deposits for a minute here, as Kira knows. And one of the things that's been a long-term trend is that traditional regional banks are struggling to grow deposits from consumers. There are less than half of banks in our research grew both consumer deposits and customers in the last year. Only about 10% are growing both at 3%, which is where most of the targets are. There are good reasons for that, which are not the subject of today's discussion. But that's really about disintermediation by non-traditional competitors, particularly the Chimes and Cash Apps of the world, as well as direct banks for the more affluent segment. The reason that matters to this audience today in business is if you are a traditional regional bank that's struggling to crack above 1 to 2% consumer deposit growth, you've got to find the funding somewhere else. And one of the areas that most banks are looking to is commercial. And in fact, last year, there was much better deposit growth for the average regional bank in commercial. It was very much backloaded towards the end of the year. But it's a kind of proof in the data that that banks are looking to this strategy to succeed and are in fact succeeding with it. Now, there's a caveat. If we go to the next page, the flip side of all of that growth is that it's been expensive. So if you, the big structural trend that those of you who are frequent listeners to our content will be able to recite chapter and verse by now, is that between the start of the rising rate cycle and the top of the rising rate cycle, you went from almost 50% of commercial deposits in non-interest bearing accounts to closer to 30%, 29%. One of the questions we got is, well, will those all come back when rates fall? Our view was not necessarily. If you look at the economics of keeping balances in non-interest bearing versus interest bearing at market rate and paying your fees. Well, here we are, well into a falling rate cycle, and guess what? The trend has actually continued, not reversed. So what that means is it's further validation of our argument that there has been a structural reset in the profitability drivers for commercial banking. And if you look over at the right, some evidence of that, still over a third of commercial deposits are priced over 300 basis points. Our betas have been lower in the falling rate cycle than they were in the rising rate cycle. And that's particularly true of interest-bearing deposits. So, implication of that, we've got to find different, smarter ways to win. If we look at small business, it's a different flavor of the same challenge. If you, the numbers are a little bit different, but at the start of the cycle, 70% of balances in non-interest bearing, that's now down to 56. Again, even as we've gotten into a falling rate cycle, that percentage has gone down, not up. And so if you think about the things that make small business so attractive, it's stable, low-cost deposits. That's an increasingly difficult falling knife to catch on to in this market. So the traditional plays, we won't necessarily trust will work going forward. If you look at interest-bearing acquisition, that's now up to 1.54%. That's getting perilously close to the averages in middle market. And if you look at what's coming in new to bank checking balances, those are actually down over the last 4 years. That means small businesses are getting a little bit savvier about how they're managing their money. And so that leads us to, again, this thesis that we need to do something a little bit different to win. The final point as we kind of build this up that we want to talk about is how do we go out and get these customers? And we can talk about this in both commercial and small business, but the most illustrative point in small business is they're not walking into the branch the way they used to. We have to find a way to go out and get these customers. That can be digitally, that can be virtually, but through a person, remotely, or that can be knocking on doors with outbound sales forces. But we need to find a way to do this the hard way, because the easy way, where it just walks through the revolving door, isn't happening at nearly the same pace that it was in the past. There's a commercial corollary here too that we've talked about a lot over the last couple of years, which is that if a borrower comes in the door and they need a loan, that's the tip of the spear, and we pull the rest of the payments and deposits relationship through behind it. Well, given the amount of disintermediation in commercial credit, if you want to keep growing, we actually need to find new ways with different value propositions, different products, and different sales forces to go out and get in front of those customers. So if you kind of put all of those things together on the next page, there are 3 real challenges if you want to win in business, whether that's in small business, commercial, middle market, corporate, specialized industries. Each of these 3 boxes are changing before our eyes. The first is around products. There is the status quo, the table stakes are different today than they were even 6 months ago, and we would expect that to continue to change as new competitors come to the market and new technologies open up new frontiers in integrating data and creating decision intelligence around that data. The second is how we find these customers. They're not necessarily coming to us the way they used to. We have to go out and find them through distribution channels. And those distribution channels have to be specialized to the ways that we're going to add distinctive value to our customers. And then finally, just finding the right customer with the right product, with the right expert at the right time doesn't get you all the way there. You also need to manage a profitability model that's in flux. And that's really where relationship pricing comes in, which is going to be an area that we're going to deep dive in on today. If you go to the next page, when we think about relationship pricing, this is a topic that we think actually applies across business segments, although with different mechanisms for how we implement it. Some of it is more around exception pricing, whereas some of it is more around how we construct our product bundles. One common theme is that it involves thinking more holistically across the total relationship and all of our products, whether they be deposits, payments, or lending. Those banks that are making progress on relationship pricing, and many are deep in that journey right now, see improved profitability, improved diversification of revenue, improved visibility into what's going on with their customers, which helps both deepen the relationship and manage risk, and that results in sticky, stable relationships. So that's sort of the setup that we have across the entire business segment. Before we deep dive in commercial and then small business a little bit more, I'll pause there and allow Margarita or Bob to jump in with any sort of questions, comments, clarifications that they have.
Peter, I think the only thing that you might have skirted over pretty quickly was on the previous slide in terms of how different sized institutions are leveraging the branch. You alluded to it a little bit, but we have very large clients on the call. We have more community-based clients on the call. And I think it's just important that we do kind of spend a little bit of opportunity here to discuss how this is being leveraged, regionally versus line of business versus specialization.
Yeah, that's a great question. So, I mean, the first observation that I would make is, for the better part of a decade, the direction on travel in branches and markets has been one direction, and it's been down, right? It's been an efficiency play. There are banks that are on offense right now, and you hear this particularly from the largest banks, leveraging their networks to go shake up markets. So, that the idea that even if you think you're in a more insulated market, well, that does depend a little bit on where you are regionally and whether or not you're getting sort of new inbound disruption. The other thing that I would note here is, particularly for the smaller banks we talk to, the idea of the branch operating in isolation is a little bit of a limiting factor. The branch can actually serve as a really powerful nucleus, but the way that smaller banks have a little bit of a capacity to do things that are harder for bigger banks is if they can really integrate the way they go to market across their lines of business, whether that be wealth, small business, commercial, with that branch as a nucleus for how they go to market. Margarita, anything you would add to that, or Bob?
No, I think that's a great point. And I think now, why don't we dig into how do those relationship pricing strategies and profitability gains translate in commercial?
I think before we jump into that, Peter's comments did spark a question from the audience to help provide a rule of thumb. What is a rule of thumb for determining the potential revenue from specific business and commercial clients? Is it their balance sheet growth, growth trends in the environment, growth trends in the regional economy, growth trends in the types of businesses, or is it a mixture of all of the above?
Well, I'll shamelessly self-promote and say those that work with us, know that we do pretty sophisticated modeling of business customer wallets, if you will, based on all of the data that we gather through our proprietary platform. So we've got we've got the answer for what's available out there. That varies quite a bit by the size of the client because they split their banking relationships more or less. The other really important piece of that is when we talk about the revenue from the client, I would actually challenge a little bit that that's the right, if that's the right way to think about it. I would really think about what's the profit opportunity from the client. And the reason I would say that is, if we were having this conversation 5 years ago, actually, the revenue from the client would probably be a pretty decent proxy. But because we've seen these big shifts where credit spreads have tightened, deposit spreads have tightened a lot for the customers who have moved away from non-interest-bearing deposits, and fees have become a more important part of the equation. How you balance the pricing across those can really make the difference between having a pretty fully penetrated relationship that actually isn't very profitable, or having a fully penetrated relationship that's also correctly priced, that offers a fair value to the client, but really, but also a sustainable value to the bank. I would be delighted to follow up in more detail with the rest of that question.
Yeah, and I think that's a great segue into how we think, so expand on that as we think about commercial relationship pricing in particular. That notion of a share of wallet that's not necessarily getting you the profitability gains you want, even though it gets creates deepening of wallet share. Go ahead, Peter.
Yeah. So if we think about kind of a continuum of commercial relationship pricing sophistication, the foundation, which almost everybody we work with does, is they look at deposits and fees in their credit models at time of underwriting and at time of renewal. The next level up is to say, on an individual basis, have we priced those well? Do we understand where we're priced relative to the market, leveraging real benchmarks? The third level is to do that not just in a silo within products, but across products. Level 4 starts to be forward-looking. Where is this going? As we all know, it's very common that banks will discount heavily or price up on deposits to win a relationship, but then over time try and rebuild that profitability through ongoing management of pricing. So do we have a view of not just where we are today, but where we could be? And then the top level is to actually track progress against that possibility. So are we continuously monitoring so we can correct both at major milestones, like, for example, a credit renewal, but also respond intentionally to things like structural changes in deposit balance levels that we have, big shifts in mix between deposit products, certainly pass-throughs at a rate increase or decrease. These are all things that happen much more frequently. And if you have this entire pricing infrastructure in place, you can really turn the dials on that to continually manage relationship pricing. We have deliberately not plotted here's where most banks are on this today. There are a couple of reasons for that. One is that banks are in really different places. The other is that this isn't entirely linear, actually. There are banks that do this really well, but only some of the time. Or there are banks that are actually engaged in forward-looking, processes around profitability projection, but don't necessarily have all of the infrastructure underneath to support it. So it's a little more intuitive versus fact-based. Our big takeaway for this group would be to ask yourselves really, really carefully, where do we think we are on this? Where do we think we're doing well? And where do we think we could do better? And one of the reasons that that's important is because this is where the industry is going. We've spent, again, for frequent consumers of our content, we're playing the hits here. We've talked about commercial relationship pricing for 5 or 6 years. It's been really gratifying and exciting to see how far the industry has moved over the last 12 months to start adopting some of these concepts. So what does it take to do that? If we go to the next page, this is something that can neither be managed entirely centrally nor entirely distributed to the field. This requires really good tools to support the process centrally from a product standpoint, but then it requires frontline engagement, both to refine the recommendations and also manage them with the client and help with a test and learn process, because these aren't static models. These are one of the things that we're learning in this sort of renaissance moment of decision intelligence proliferation, is that things evolve. We could test and learn from the field. And so getting that frontline input back into the models is really important. In terms of how we deliver this to the market, if we go to the next page, here's where we want to talk a little bit about kind of what our actual approach is, but also, more broadly talk about what's changed in the market that's made this possible. So we are, over the last 12 months, where we have AI kind of moving a little bit out of sort of the operational back office component towards customer decision intelligence. One of the things that we have is much greater ability to process messy data sets. That was always one of the really big challenges in commercial, is there are just so many moving pieces to make this work. The second thing that we've got is much better connectivity between those data sets. And so all of this is making possible the sorts of real-time pricing intelligence that really we just didn't quite have the railroad track laid for 24 or 36 months ago to do at scale. All that's changing before our eyes. And when we kind of looked at this space, we thought, gosh, there are different players who handle different parts of this really, really well. We, of course, have a really unique data component to it, but we looked at where banks were going for pricing tools, and we built partnerships so that we could collaborate with these. Margarita, I'm going to pause there and see if there's anything you want to add on that sort of description, either in terms of structure or in terms of the way that banks are leveraging that and getting value out.
Sure. We're most excited to partner with real disruptors in this space who are helping banks transform how they think about relationship pricing. In working with SunTech, Whiteclay, and Zafin, we're able to complement their best-in-breed capabilities with our best-in-class benchmarks, so that you begin to embed benchmarks into that decision moment that matters, which is when the front line is getting ready to get in front of a client and is starved for market insights, a sense of where they should be aiming their pricing at. This really helps them be empowered and informed as they take the best possible negotiated pricing strategy to market, and position both to win, but still to preserve profitability.
Great. So if we move forward to where we kind of go from here, this, if we think about how we navigate the commercial strategy in light of this moment of transformation and the new tools that are available, we really think about 4 key questions. 1, do we have clarity on where we're going to win? Since we're winning in more specialized ways that add value through expertise and products and connectivity, the sort of will be everything to everyone strategy is much more challenging than a very focused, targeted strategy. The second question is, once we've decided where we're going to win, do we have both the right products and the right organizational alignment to go to market? Those are 2 questions that we've dealt with a lot of our clients over the last 12 months and expect to do more of going forward. And then finally, once we've decided where we'll compete, we've built the tools, we've built the team to get it to market, have we given them the data to succeed profitably? These are all really important questions. And again, these are all things that our data, our platforms, and our advice are designed to help banks navigate.
So Peter,
and then,
one of the things that I think, let's just come back to the fact that we have a broad range of complexity as well as size on the call. If you were to put yourself, and same goes for you, Margarita, in the armchair of some of the leadership on this call for a given bank, where would you start? What's most important to start with and why?
Well, I think you start at the start. Are we intentional about where we're going to compete? It's a little circular because I don't think you can answer that question without also understanding, well, can I win? And just because I want to compete there, can I win? Do I have the capabilities? Do I have the balance sheet? Are there a lot of customers that meet those parameters in my markets? And then if I do that, is that going to meet my balance sheet needs? Do I have the right tools to do that profitably? And then specifically in this business, there are really different profiles of sort of net funders versus asset generators from a bank perspective. And so you need to be clear on what you're trying to solve for in the context of your broader balance sheet and income statement. So that's a long way of saying you kind of got to do all of them, but if you don't have clarity on who you're going after, almost none of the rest matters.
The one thing I would add is it's also important to be aware of what are your likely constraints. So a smaller institution is going to have a much less robust budget for investing in differentiation and product innovation. So you really have to be tight about picking your spots and selective with where you believe you will win and can win. But you also have the advantage of being smaller. The odds that you are collaborating across segments is there's a much higher likelihood that is part of your culture, that is part of how you show up in market. Whereas the largest banks may have all of the innovation, but the odds that they are surrounding a small business owner, for example, with all of the capabilities they could bring to bear in a seamless, low friction interaction is slim, because the ability to talk and collaborate across the large organization is usually constrained. So I think recognizing what's likely to help you set up, kind of step apart from the rest of the competition and set you apart, that's key to lean into. All right.
Thank you both.
So let's
one last thought here is,
yep, go ahead.
Yeah, just so this stuff is hard. The question is, what's in it? And these are, when we look at business, there's always the story and the story behind the story and the story behind the story behind the story, right? But when we just look at the numbers, what we're seeing in our data, when we try and normalize for as much of that as we can, is, top quartile performers, you're looking at 5 to 10% balance growth versus flat or negative for the bottom quartile. If we try and sort of normalize as much as we can about the mix and the size of the balances and so forth, there's almost 10 basis points of give and take on deposit pricing in most books between those who do it really tightly and those who do it less tightly. And then when we look at treasury management fee growth, which is really a function of both pricing but also the effectiveness of the cross sell and go to market, that's that's sort of a 7% difference in gross fees between those at the very top who are pushing through, in some cases close to 10% top line growth. I mean, there are a few out there, maybe some on the call, who will say we actually did better than that last year, versus those who are sort of ticking away at the standard. We'll do a 3% pricing event every year, every other year, and give some of it back on discounts, waivers, or just jack up the ECRs, right? I mean, it's a little critical, but there are real differences in the business performance that we see expressed in the numbers. Bob, did we have any final questions come through on commercial?
We do have a few. I'm waiting till we get to a more appropriate section that'll help address them.
Okay.
It appears we lost Margarita. So let's move on to the next slide.
Okay, great. So we're going to do something a little. Oh, Margarita's back. I was going to take over.
I'm back. What terrible timing for me to get dropped. So let me bring back up the presentation. My apologies.
Further proof that these events are not scripted every year.
They are not. No, they are not. And thank you both for being ready to jump in. All right. Any final comments, Peter, or shall I jump into the small business section?
You're on.
Okay, excellent. All right. So as Peter shared earlier in the presentation, a lot of the recent focus in small business has really been driven by the desire to bring in low-cost deposits. So that value of a stable, low-cost portfolio is being eroded by the higher cost of bringing in new balances. As I was telling one bank leader recently, it's like the whole industry is trying to squeeze the cute out of the puppy. Small business has been a great segment to push into, but it's starting to be more costly. Where we want to start thinking more broadly, though, is that as banks are looking to win the low-cost deposits, they also have to be willing to meet the full needs of those small business clients. Otherwise, those deposits may not last. So as you can see on the left-hand chart, after 3 years, clients with a lending relationship have over twice the deposits with their bank than clients without a lending relationship. Our proprietary studies also show that the #1 driver of convenience when selecting a primary business bank is having strong digital capabilities. So that means that if you want to win that deposit, you need more than just the right products and more than just your own singular focus on winning those deposit relationships. When we look at what best-in-class banks are doing to uniquely win in small business, we look at a number of factors, and this is particularly important to hit across all of these dimensions when you're really trying to address a market that is rapidly shifting because of fintech disruptors. The fintech disruptors are carving out individual pieces of the relationship. Banks can take a more holistic, multifaceted approach, but it needs to be operating across multiple dimensions to be effective. So the first one that we want to talk about, and I'll go into some statistics here, is having an effective lending engine is obviously table stakes. It always has been, but how you show up with your clients is continuing to differentiate between those who are best in class and those who continue to struggle. You also have to have a superior digital experience. So really making sure that you can rival what fintechs are offering, being as frictionless as possible, and making sure that those experiences serve the purpose of deepening relationships. I'll be sharing some statistics there as well. The two areas that I think are a little bit harder to put your finger on and often need more help from folks across the industry to really optimize. Channel strategy is a key piece where you begin to look at, I have a branch network that exists. I have a sales model today. How do I make sure that those pieces operate across a continuum of small business needs so that I'm meeting those small businesses in the moment with the right channel that's appropriate to capture that business, but then I continue to grow with those clients' needs so that I don't lose them as they become a more complex, larger, successful business. In particular, we see that as very important in the wealth space, so that your ability to focus on the needs of the business in tandem with the needs of the household is a critical opportunity. And then lastly, having those great products that reflect your value prop. Here again, that continuum of product needs that a small business requires from their primary bank, it's important to understand how that continuum matches where you believe you can offer differentiation, and then how do I have the economics to support it. It can be really, there can be a strong cannibalization effect of bringing small business clients into a package that meets their initial needs, but then growing with them to ensure that as they require more complexity, you actually begin to charge for that ability to meet their needs. And then making sure that those products really match your own proof points of why should they be banking with you. So attracting them through the promise of certain products has to be delivered against. All right,
Margarita, the one thing that,
go ahead.
Where on this list of 4 items do you see that we've kind of seen banks sharpen their pencil enough versus the most opportunity to continue improvement relative to competition?
I think, again, the answer to an extent is it depends. Institutions have chosen pockets where they're going to press in. As Peter mentioned earlier, some of the largest institutions are really reinvesting in the branches. Clearly having product investments has been a priority, and we're seeing some advancement in the digital experience, but not nearly enough. So what I would say is I see a lot of institutions tackling these in silos instead of looking at how do these work together to surround my small business growth strategy and make sure that I'm operating across the continuum of needs and really bringing all of these to bear in how I plan to win. Anything you would add, Peter?
Well, maybe it's just doubling down, but there are real points of connectivity between these. So, for example, how you build your products cannot be disentangled from who you're trying to sell them to and who is doing the selling. If you're going to have a sort of lower cost sales force, you better have really simple products. If you're trying to push your business banking up to $25 million sales size companies, well, you better have really good products. So it would just kind of reiterate that they really do work together.
All right. Let's move on to some quick hits on credit insights. For many of you, you belong to our Business Lenders Benchmark Analyzer. Wanted to share some highlights of what we saw last year. And for those of you who are not in our lending trends, this would be a great follow-up conversation as we see a lot of focus here. So what were some of the trends that we saw? On the left-hand side, across all products, we saw that applications definitely rose, especially in secured loans, but that booked dollars definitely declined year over year. So as we can see, banks pulled back funding most from the secured lines of credit and unsecured loans. Small business or SBA-based loans also took a hit. But from a utilization perspective on the upper right, we see that SBA utilization does continue to be strong. On the bottom right, we're starting to see delinquency rates rise in a few key industries. So in a tight credit environment and those delinquency risks modestly rising, it's really important for banks to know how they can compete against this context. When we look at what can banks control, certainly they're striving to bring top of funnel activity. They're striving to attract more application volume to them. But what we see as incredibly impactful is what happens once they bring those applications in the door. Well, there are two key areas that banks can focus on to drive impact. Number one is their cycle times, and number two, of course, is their pricing. On the left-hand side, we can see that the median calendar days from application to booking has shaved off a whopping 40% in recent years. So many banks are focusing on tightening their cycle times. The 25th percentile continues to steadily improve, but interestingly, the laggards' recent efforts to improve there have actually reversed course. So we're seeing some backsliding as banks can sometimes forget to maintain focus on continuing to be efficient and effective with their lending engine. On the pricing side, we see meaningful variance across bank performance, especially in terms of how they price for risk. So I'm not sharing broadly, but for those who are in our benchmarks, we're able to actually overlay this with risk scoring so that you can really see where do I stack up in terms of making sure that I'm pricing for risk. We note here that the range of pricing is the widest in secured lines of credit and in unsecured loans. Those are also the two categories on the previous page where we saw the largest declines in booked loan dollars. So it's interesting that there's a correlation there where some of those declines that we're seeing, we're also seeing a broader spread of pricing strategies as some banks are pulling out of some product types, whereas others are continuing to lean in to win that business. So as listeners on the call, think about where should I be focusing my efforts to develop a winning strategy in my lending engine. These two areas can drive a lot of impact. One other area I wanted to focus in on briefly was that digital journey. So in this arena, financial institutions have really come a long way, but they also have tremendous opportunity for further sophistication. As we look at number one, that end-to-end digital account opening is now table stakes. If you do not yet have a seamless digital account opening capability, you will be left behind. What was good enough a few years ago is no longer good enough. We also see, though, that digital onboarding experience is evolving beyond that initial account opening. So after getting that initial access, really driving through to those digital features is key. Lastly, point number 3, personalization and then activating that new relationship is essential to that relationship deepening. We see that only 10% of banks deliver immediate pre-approved product offers after onboarding. When we think about that missed opportunity with a new relationship to immediately begin engaging around potential expansions of the relationship, that's a huge untapped potential, especially in a digital dominant world. When we think about the small business space, remembering to capture those basics, right? So asking yourself, am I pricing and deploying credit strategies that align to that long-term relationship value? Do I have the products and digital experience that reflect my unique value prop? And do I have market offers that successfully bring over full relationships? That's where we get into relationship pricing for small business, is about finding that point of entry, but then rapidly expanding to get full wallet share. So do you have the flexibility in your distribution channel strategy to have tailored entry points, but then expansion strategies that meet their needs while also generating those valuable low-cost deposits? Here again, in this segment, the value is real. So as we examine specifically clients who reshape their lending engine to drive faster, more profitable growth, the metrics that we see after working with us for 12 months, 7% annual originations growth, a nearly 50 basis point average spread improvement, an over 3% increase in utilization because of that fine tuning of that credit need, and then a meaningful improvement in delinquency rates. So this is an area that Curinos has been delivering value for a long time in. We wanted to really showcase that side by side with how we help small business segments. All right, we're going to go into any questions or comments, Peter or Bob, that you would want to add in this area.
You nailed it.
Okay. All right. We're going to go into a quick live poll. We've covered a lot of topics today, so we really want to hear from the audience in terms of what is driving your top strategic priority. You can choose 2 of these options because they are so very different. So feel free to choose 2 that you believe are your top strategic priorities. All right, we're seeing some good movement up and down. We'll give it a few more seconds. All right, we're starting to stabilize. All right, are you able to share the results, Megan, or maybe Peter?
Yeah, they're shared.
Yeah.
Okay.
Well,
great.
we have a winner, and it's commercial relationship profitability. That is that's not a surprise to us based on all of the focus that we've seen on this topic over the last year. Whether that's been thinking about how to think about this, how to embed it in the business through pricing tools, and then how to measure outcomes. Lots of responses also around 2 other areas in particular: the differentiate value in products to strengthen the right to win, and then the client digital experience. Those 2 go really hand in hand in both segments, but especially in small business. So this notion of gosh, we can't be everything to everyone in every place. We need to in this kind of competitive environment explain why us, and then go put our money where our mouth is, put through our products and our digital experience. Branch and channel effectiveness and revving up your small business lending engine, distant 3rd place finishers.
Right.
So yeah, more to come there. I do wonder if I do wonder on the last one if we had asked the question a little bit differently on sort of separated out branch versus branch and channel, if we would have gotten different results. But hindsight is 2020. And then I think maybe on that last piece on small business, so we feel like we can kind of get some volumes, but maybe the way to rephrase that question is, are we really doing everything we can from a pricing and a risk standpoint with the volumes we're getting in the door? So that's my take on the results. Happy to share them, but there you have it.
Great, thank you. All right, let me go forward. Final comments, and then we'll talk. Look forward at the calendar. Peter, did you want to cover anything, or shall I? Sorry.
Oh, yeah, happy to speak to this. So, look, we've talked about this, the challenge posed from outsiders, whether they're fintechs or other non-traditional competitors, or even just traditional banks really doubling down in these segments. Kind of the antidote to that, we say challenge is new reality. I think of the right as the antidote is we got to be really clear on why it is that clients should choose us, and that needs to be expressed through our products and experience. Fragmented growth strategies, the sort of be everything to everyone everywhere is harder to execute. We got to be really clear on who we're going to win, where we're going to win, and then how we're going to go and get in front of them. This distribution channels, I don't know if there's a perfect word for this, but it's our branches, it's our digital, and it's our sales force, but not just our sales force. It's the way we construct our sales force in terms of different specialties and types of bankers, what's outbound versus what's inbound. And then, hard to react with so much change, actionable decision intelligence, as we've said, there's stuff that's just possible today that wasn't a year ago. When we look at the power of AI to process the data that we can get all in one place. So this is we'll sort of finish where we ended, which is we got to find the relationships, deepen the relationships, and then make sure we get them priced so that they work for everybody involved. And if we do the right-hand side, we can get there. I will leave Margarita 2 minutes for the most fun part.
So for those of you who joined us last year at the Business and Wealth Summit, we're excited to announce our dates again for this year, September 28th and 29th. We also are going to do a new dedicated small business forum the afternoon of Tuesday, September 29th. So we're excited to expand the agenda to include a focused deep session on small business. And then last but not least, where should we go? We would love to hear some thoughts on central locations that would be fun destinations for our summit. So quick live poll: Denver, Austin, Chicago, or Nashville? I am from Denver, so full disclosure, that's certainly one of the horses in the race for me, versus Peter and Bob, who are Chicago based. All right, thank you. I think we're seeing some good horse race between Denver and Chicago. All right, why don't we go ahead and close the poll, and then I will wrap us up. So thank you so much for joining us today. We've enjoyed our time together. If you have any questions, please feel free to reach out to Peter, myself, or Bob. You will receive the recording and materials shortly from Megan, and we look forward to many forward discussions. Thank you, everyone.